For more than a century, the global financial system has operated on a fragile promise. That promise is simple. Debt today will be paid by growth tomorrow. Every major financial crisis happens when that promise breaks. Not suddenly, not randomly, but after years of warning signals that most people ignore. This script traces the exact economic mechanics behind every major financial collapse of the modern era. How money was created, where it flowed, why it concentrated risk, and how that risk finally detonated. Crisis number 1, the Great Depression, 1929. The Great Depression was not a sudden accident. It was the final outcome of structural weaknesses that built up throughout the 1920s. After World War I, the United States emerged as the world's largest industrial economy. Factories became more productive. Corporate profits increased. But income distribution became uneven. Wages for ordinary workers did not rise at the same speed as productivity. To maintain consumption, the economy relied increasingly on credit. Banks aggressively promoted loans. Consumer credit for goods. Corporate loans for expansion. Stock market loans for speculation. Buying stocks on margin became widespread. An investor could control $100 worth of shares with only $10 of actual capital. This leverage multiplied gains, but also multiplied losses. By the late 1920s, stock prices were rising faster than corporate earnings. Valuations were based on optimism, not cash flow. Financial newspapers promoted the idea of a permanent boom. Speculation replaced investment. When small corrections appeared, they were ignored. In October 1929, selling pressure increased. Margin calls forced leveraged investors to liquidate positions. As prices fell, banks faced losses on stock-backed loans. Depositors rushed to withdraw savings. Thousands of banks failed due to lack of deposit insurance. Credit collapsed across the economy. The gold standard limited central bank response. Money supply could not expand freely. Instead of stabilizing demand, interest rates remained restrictive. Money circulation shrank. Prices fell. Businesses cut production. Unemployment exceeded 25%. The Great Depression permanently changed economic policy. Banking regulation was introduced. Deposit insurance was created. Central banks gained a stabilization role. The core lesson was simple. When leverage grows faster than income, the system becomes unstable. Crisis number 2, Bretton Woods and monetary dominance. The collapse of the Great Depression taught governments one lesson very clearly. Uncontrolled money flows and competitive currency devaluations can destroy global trade. When World War II was still ongoing, global leaders began planning a new financial order. The birth of Bretton Woods, 1944. In July 1944, delegates from 44 Allied nations met in Bretton Woods, New Hampshire. The objective was not growth. It was stability. The agreement created 3 pillars. 1. Fixed but adjustable exchange rates. 2. The U.S. dollar as the global reserve currency. 3. International institutions to manage crises. Under this system, all major currencies were pegged to the U.S. dollar. The U.S. dollar was convertible into gold at $35 per ounce. This effectively placed the United States at the center of global finance. Why the dollar was chosen. At the end of World War II, the U.S. held nearly 70% of the world's gold reserves. American industry was intact. Europe and Japan were financially exhausted. Trust in the dollar was not ideological. It was mathematical. The U.S. economy was strong enough to anchor the system. Institutional control, IMF and World Bank. 2 institutions were created. The International Monetary Fund, IMF, to manage balance of payments crises. The World Bank, to fund reconstruction and development. On paper, these institutions were neutral. In practice, voting power was proportional to financial contribution. This ensured long-term U.S. and Western influence over global monetary policy. The hidden flaw, Triffin dilemma. The system contained a structural contradiction known as the Triffin dilemma. To supply the world with dollars, the U.S. had to run trade deficits. But persistent deficits, undermined confidence in dollar-gold convertibility. The system required the U.S. to do two opposing things simultaneously: provide liquidity, maintain scarcity. This was impossible over the long term. Expansion of U.S. deficits. During the 1950s and 1960s, U.S. military spending increased. Vietnam War costs surged. Domestic welfare programs expanded. Dollars accumulated overseas. Foreign central banks held dollars, not gold. As confidence weakened, countries began demanding gold in exchange for dollars. The 1971 shock, end of convertibility. By the late 1960s, U.S. gold reserves declined sharply. Dollar liabilities exceeded gold backing. In August 1971, President Richard Nixon suspended dollar-gold convertibility. This decision ended Bretton Woods, turned the dollar into a pure fiat currency, removed external discipline on money creation. The announcement was framed as temporary. It was permanent. Monetary dominance after Bretton Woods. After 1971, exchange rates floated. Capital controls weakened. Debt expanded rapidly. The U.S. gained an extraordinary privilege. It could finance deficits by issuing its own currency. Other countries had to earn or borrow dollars. This asymmetry became the foundation of modern financial crises. Long-term consequences. Bretton Woods solved post-war instability, but its collapse introduced a new era. Repeated debt cycles. Asset bubbles driven by excess liquidity. Global dependence on U.S. monetary policy. From this point forward, financial crises would no longer be local. They would be global. Crisis number 3, oil crisis and stagflation, 1973 to 1980. The collapse of Bretton Woods removed the anchor from the global monetary system. Currencies were floating. Money creation was accelerating. At the same time, the world economy depended heavily on a single input: energy. Why oil was different? Oil was not just another commodity. It powered transportation, manufacturing, agriculture, electricity generation. A rise in oil prices affected every layer of the economy simultaneously. The geopolitical trigger. In 1973, after the Arab-Israeli War, Arab members of OPEC imposed an oil embargo on countries supporting Israel. Oil supply was deliberately restricted. Prices increased nearly 4 times within months. This was not a market accident. It was a geopolitical weapon. Transmission into the economy. Higher oil prices increased production costs. Businesses faced a choice: raise prices, cut output, or lay off workers. Most at all 3. Inflation accelerated rapidly. At the same time, consumer demand weakened due to rising living costs. Growth slowed. Breakdown of economic theory. Until the 1970s, economists believed high inflation occurred during strong growth. High unemployment occurred during recessions. The oil shock broke this relationship. The world experienced high inflation, high unemployment, low growth. This condition became known as stagflation. Policy failure. Governments responded using outdated tools. They increased spending to fight unemployment. Central banks accommodated inflation to support growth. This response intensified the problem. More money chased fewer goods. Prices rose faster. Confidence weakened. The interest rate weapon. By the late 1970s, inflation in the United States exceeded 13%. The credibility of monetary authorities collapsed. In 1979, the U.S. Federal Reserve reversed course. Interest rates were raised aggressively. At their peak, rates exceeded 20%. This policy crushed inflation, but also triggered deep recessions, bankrupted debt-heavy borrowers, redirected capital toward the U.S. Global spillover effects. High U.S. interest rates strengthened the dollar. Developing countries that had borrowed in dollars faced exploding debt costs. Capital flowed out of emerging markets. This directly set the stage for the Latin American debt crisis, a new era of financial volatility. Structural legacy. The oil crisis permanently changed economic thinking. Central banks prioritized inflation control. Energy security became national policy. Interest rates became a primary crisis management tool. But the deeper consequence was structural. The world learned that supply shocks combined with loose money can destabilize entire systems. This lesson would be repeated again and again. Crisis number 4: Latin American debt crisis, 1980s. The Latin American debt crisis was not caused by irresponsible countries alone. It was the result of global monetary decisions taken thousands of miles away. The origin: petrodollars and easy credit. After the oil shocks of the 1970s, oil-exporting countries accumulated massive dollar surpluses. These petrodollars were deposited in major Western banks. Banks faced a problem. They had too much money and needed borrowers. Developing countries became the solution. Throughout the 1970s, loans were cheap. Interest rates were low. Growth projections were optimistic. Latin American governments borrowed heavily in U.S. dollars. Debt financed infrastructure projects, industrial expansion, government spending. The assumption was simple. Future growth would easily repay the loans. The currency mismatch trap. Most of these countries earned revenue in local currency, but their debts were denominated in dollars. This created a structural vulnerability. If the dollar strengthened, debt burdens would explode. This risk was underestimated. The shock: rising interest rates. In the early 1980s, U.S. interest rates surged to combat inflation. As a result, dollar interest payments increased sharply. Global capital flowed back to the United States. At the same time, commodity prices weakened. Export revenues fell. Debt servicing became impossible. Mexico breaks the system. In August 1982, Mexico announced it could no longer meet its debt obligations. This announcement triggered panic. Banks feared a chain reaction. Countries across Latin America faced immediate pressure. The crisis was systemic. IMF intervention and conditional bailouts. To prevent bank collapses, international institutions intervened. Emergency loans were issued, but with strict conditions. Sharp cuts in government spending. Currency devaluations. Privatization of state assets. Trade liberalization. These policies stabilized external payments. But internally, they caused deep social damage. The lost decade. Economic growth collapsed. Unemployment surged. Public services deteriorated. For much of Latin America, the 1980s became known as the lost decade. Debt was restructured, not erased. Economic sovereignty was weakened. Structural lessons. The crisis exposed a harsh reality. Dollar-denominated debt transfers risk to borrowers. Monetary policy in powerful economies shapes outcomes globally. Financial stability was restored. Development was delayed. This crisis established a template. Debt crisis bailout, austerity, long-term stagnation. That template would be reused in future crises. Crisis number 5: Japan's asset bubble and the lost decades, late 1980s to 1990s. Japan's financial collapse was not caused by poverty, corruption, or weak institutions. It happened at the peak of success. Japan's rise before the bubble. After World War II, Japan rebuilt rapidly. By the 1970s and 1980s, Japan became the world's second-largest economy. Exports dominated global markets. Productivity and savings rates were extremely high. Japan was running large trade surpluses, especially with the United States. This success created political pressure. The Plaza Accord, external pressure. In 1985, major economies signed the Plaza Accord. Its goal: reduce the U.S. trade deficit. The method: force the Japanese yen to appreciate against the U.S. dollar. The yen strengthened sharply. Japanese exports became less competitive. Monetary response: easy money. To offset slowing exports, the Bank of Japan took action. Interest rates were cut aggressively. Credit became cheap and abundant. But instead of flowing into productivity, money flowed into assets. The asset inflation spiral. Banks expanded lending based on collateral values. Rising asset prices justified more lending. This created a feedback loop. Higher prices, more credit, even higher prices. By the late 1980s, stock market valuations became extreme. Real estate prices exploded. At the peak, the land value of Tokyo was estimated to exceed the total land value of the United States. This was not sustainable. The trigger: interest rate tightening. In 1989 to 1990, the Bank of Japan raised interest rates. Credit growth slowed. Speculation reversed. Asset prices collapsed. Balance sheet recession. The collapse created a new type of crisis. Companies and banks were not insolvent, but over-leveraged. Their priorities shifted from expansion to debt repayment. Even at near-zero interest rates, borrowing demand vanished. This phenomenon became known as a balance sheet recession. The lost decades. Japan entered prolonged stagnation. Growth remained weak. Deflation persisted. Government debt surged. Policy tools lost effectiveness. Stimulus prevented collapse, but not recovery. Structural lessons. Japan proved several critical truths. Asset bubbles can cripple advanced economies. Monetary easing cannot quickly fix balance sheet damage. High debt can trap economies in long-term stagnation. Japan did not collapse suddenly. It faded slowly. That made it even more dangerous as a precedent. If this breakdown helped you understand how financial crises really work, not just what happened, but why it keeps happening, then support the channel. A like tells the algorithm this kind of deep, research-driven content matters. Sharing the video helps it reach people who want facts, not noise. And subscribing keeps you connected to future episodes where we break down money, power, and global systems exactly as they are, not as they're sold. Thanks for watching.